All right, little impromptu live session today, Tuesday, February 24th at 2:15 p.m. And I want to talk about the software apocalypse and the fervor generated by a single article yesterday. And I just wanted to see in the options data if there was actually any apocalyptic behavior. I'm not really great at saying that word. And I'm going to watch a little chat here. I know it's impromptu, so maybe no one sees this right away. We're going to go through a couple things to see what the state of the market is, because yesterday the vibe was that the whole world was falling apart. Citrini article, just, I mean, the virality of that thing was really pretty wild and didn't really sync up with market action all that much. Some certain names were pretty beat up. And what I think is about that, interesting about that, is the fact that the price action seemed to scream day trading, momentum, this and that, as opposed to saying biggest funds in the world are not dumping anything related to that could ever be upset by AI. And I don't really have feelings about the article myself, except to say that people are pretty adaptive. And so you can forecast a bleak future, but the reality is that we're all going to figure out a way to make a living, right? We're going to find some service that's interesting. Maybe it means we all just got to go back to seeing each other and paying to hang out together. Something, I don't really know. But the idea that we all just sort of lay down and die because of Claude or whatever is an interesting one. Anyways, my nose aside, let's take a look at a couple of things that we're seeing here, and so we can break into this. The reason I went with a live video here rather than a article that I was writing or something is I just want to show a bunch of tools in action. I just think it's easier to go through this. And so I'm starting off with the founders note today. Paulo, so founders note, we write this every single morning. SpotGamma subscribers get to see this. We always talk about S&P resistance. And the reason I want to start with this is because it matters. Because if you look at the way that the market has been trading, we talked about this last week, Goldman touched on it too, that the S&P range has been the same range since Thanksgiving, excuse me. So if I scroll down a little bit farther, I'm going to cheat here. Look at this range, right? This is December FOMC. You can go all the way back to actual Thanksgiving and see we went over 6,100 at Thanksgiving, and it's been this exact range. So when you look at this, you know, can you point to me where this, you know, private analyst wrote about the death of every white collar job, whatever it is. I mean, some of the things coming out is crazy. You can't see it on this chart, in the S&P chart, right? Now, article has a lot of great points. He's clearly a very brilliant individual. So no, I'm not throwing shade at anything that's in that. I'm just simply saying the market was freaking out about this thing. And if you look at the S&P, it didn't do anything. And what's the S&P doing right now? Guess what? It's right back here to 6,900. So, okay. So from a high level, fine. And what are the dynamics there? Positive gamma continues to form at 6,900 to 7,000. What does that mean? Every time we get in this area, people come in, they start selling calls, and they sell more calls, and they sell more calls. S&P drops. Okay. And then we bounce back up, and the same thing happens. It's just rinse and repeat. So we've not been able to break that level. NVIDIA earnings tomorrow, as well as some of the software earnings, are coming up, and I think that's important, which is why I was like, let me just do a little video here and just see what's up. Jesus Beltran, I love you too, man. Okay. I put this quote in because I thought this was also hilarious. The notes on the Citrini attention, which he's a private individual doing analysis, so it's not all that unlike us. I mean, clearly, I've never had anything anywhere near that. Get that kind of attention. So I'm not pretending I know what that's like. But the idea that it sort of annoyed the banks a little bit was pretty funny. And I thought that this was kind of hilarious and true. This is a quote from apparently this guy Michael O'Rourke at Jones Trading, and it said, "It's remarkable action. I haven't seen this market exhibit incredible resilience in the face of actual negative news. Now a literal work of fiction sends it into a tailspin." I mean, that's hilarious. And then I saved this article too because this guy from Goldman says, whether you agree with the rationale behind today's latest blog post or not. I think there's 100,000 words in that article. Again, I didn't look at it myself. I was like, everyone's reading it. I don't want to read it. But so that's funny. It's clearly like there's a little bit of a poke there. And then the idea is that it is getting attention and opening up all these new ideas. So, all right, Brent, get to your point, right? I'm going to come down to a couple of different things. I'm going to start with a more of a basic interpretation of things. So this nice chart here, what we did is we just took options volume. Nothing fancy, just options volume, not our SpotGamma open interest stuff or weighted by this or that other thing. Just what was the options volume yesterday? versus the last 30 days. Okay, so here's put call volume ratio, put call open interest ratio, put volume versus the last 30 days, call volume versus the last 30 days, and then here's your total volume. We break this down into baskets, and I added 2 unique baskets to this. Again, if you're SpotGamma founder, excuse me, if you're SpotGamma founder, you can have all you want. If you're SpotGamma member, you can see this in our founders note today. And if you're not, I'll post a link in the YouTube chat so you can see this. Okay, so there's a software basket. The software basket is tied to IGV, the ETF. And then there's a digital payments bucket. And so the digital payments bucket included a bunch of names that were in the Citrini article, or maybe were linked to it or whatever. So like AXP down 7%, pretty nasty yesterday. That's included in this bucket as well. So what do you notice about this? Number one, what was the put call volume ratio? Not even 1-to-1 for anything in here. Now, single stocks tend to trade more calls than puts historically. So positive ratios or ratios under 1, I should say, no matter. But consumer defensive clearly bearish in that more puts traded than calls. But digital payments, very low in terms of these ratios, right? And the same thing in the software sector where, the scale is based on the other sectors here. It wasn't even the most bearish sector in terms of put call services ratios. Financial services, okay, a little bit more. But again, the point here overall is that from a volume perspective, we didn't have 1-to-1 put call, much less higher than that. And then the second one is from an open interest perspective, we don't have 2-to-1 puts or even 1-to-1 puts right now. So why that's interesting to me is because if you day trade stocks, you can push a stock around, right? You're in, you're out. No one really knows what your intentions are, right? But when you trade an option, when you decide I'm going to buy this contract that expires tomorrow, next week, 6 months from now, be it a call or put, or you buy or sell that call or put, you're putting a stake in the ground, right? You're saying, I believe in this position. This is what I'm doing. Now you can be hedging and but on its face value, that's what you're doing, right? You're opening a contract. You're there. You're not, let's day trade the Citrini blog, whatever it may be. So the options positions, there's a lot of information, and I think it matters. And that's core to the point of this whole thing is that if I was to show you this chart and said, hey, what do you think happened in these sectors yesterday? You wouldn't have seen, I would argue, nothing in the digital payment space. If anything, what was interesting is call volume seemed more elevated in the last 30 days. This was 1.2x's. Overall volume, 2% of the overall volume of this entire sort of page here, which is 500 symbols. You had to have at least 5,000 options volume to be on this page. So, okay, actually looked like digital payments trade a lot of calls. Now, were those short calls or long calls? We have a tool called Flow Patrol. We're going to break that down for you in a second. But on its face, if you see giant put volume trading somewhere, record put volume, that's usually the sign of a washout, or vice versa. Huge call volume oftentimes is the size of a spike. You don't get that in the software space. Now, software's already been beat up. Some of these names are down a little bit more yesterday, but I think a lot of this is momentum trade and tied to the dispersion. What do I mean by tied to dispersion? One of the trades that's been dominating the talk on FinTwit, is the thing we've been talking about for months, is correlation and dispersion, meaning the underlying stocks in the S&P 500 or the NASDAQ have been moving a lot and relative to the index. And that finally became mainstream FinTwit stuff. Last week, Michael Batnick put out a note about the fact that, stocks are moving a lot and S&P isn't. And that finally got everyone on this idea. Well, what is it when software stocks move a bunch and financial stocks payments move a lot and then the index doesn't do anything? That's just more of the dispersion trade that we've been seeing right now. Was it, you want to blame solely this article or not, or was that the cause for momentum or not? You can argue about that back and forth. I would say that Claude today announced 15 new plugins or whatever it is. Software stocks, they're all right now. You can see IG very here still up on the day. So, we'll see. Okay. So, all right, Brent, the takeaway from here is put buyers didn't apparently come in despite this blog. That's a signal to me that action that was taking place was people trading stocks for the sake of trading the stock as opposed to having a fundamental view. Let's get up to something a little bit more interesting. This is a little more complicated if you're not used to looking at options flow, but it's pretty easy to understand if you give me a second. Here is IV rank. What is IV rank? Options prices have a volatility associated with them. And so what we do is we rank those IVs or those options prices over the course of the last year. And you say, are those options prices high or are they low? Is IV high or low? Same kind of term. The higher IV is happening when stocks are crashing. Typically, you can have a stock crash up, which generate high implied vol. But generally speaking, when a stock is crashing, you're going to have high implied vol. Why? Because people see the stock crashing. They expect a lot more movement in the future. Options prices go up. So why is that significant in the high IV space? Look at the names up here, right? Adobe, CRM reports tomorrow, Snow, Zoom reports tomorrow, Intu reports in 2 days. Datadog is pretty elevated. They already reported. IGV is a software ETF. For a normal stock going into earnings, you would expect the IV rank to be somewhere around here, generally around 30. If it's just a normal day, going to report earnings, cool. So the names that are 50 and above, that's telling you that the price action is pretty wild, right? And so why does this matter? Because this is going to relate to, number one, the thinking that's happening in the space, right? Why do options prices get expensive? Number one is because there's a lot of volatility. So if there's a lot of volatility, then you would have to adjust the options prices to account for that volatility. Okay, so that's kind of changing relative to the price action. The second reason that prices in options may go up is because of dealer exposure. So let's say that everybody here is buying puts in Adobe. Market makers are going to be selling those puts, and banks are going to be selling those puts. They don't want to be short puts anymore. What do? They raise the price. When you raise the price of those puts, i.e. the IV rank goes up, right? And incentivizes selling. Either people who own the puts want to sell them, or people who want to short them. Hey, that's really fat premium. I'm going to come in here and sell those. So if you look back at this here and you go, well, the open interest is not really that put skewed and the volumes aren't exceptional, you can make an argument that this isn't really a positional IV increase as much as just a reflection of the stock volatility. So why does that matter? The IV is getting so rich that I think that it in itself becomes a reason for these stocks to bounce. I've been making this argument, and last week it seemed to come a little bit to fruition. Now, obviously, IGV is a little bit lower than IGV was around 80, 81. When we're talking about this, it did shift a little bit lower because of allegedly this blog. But regardless, these IVs are very expensive, and it's going to be an interesting trade in a second that we can talk about. What is the other thing here? Puts on the left and calls on the right. What do I mean by that? The more put IV is high relative to calls, the more we are on the left of this chart. So to the point of last week, things were shaping up and then they slid lower. The line here on the chart is telling you what happened over the last 5 days of history. So the line starts on the right side and it moves to the left, tells you that people are starting to like calls or at least sell some puts, right? The call skew was picking up relative to the put skew. And now it's sort of slammed back to the left over the last 5 days. That was also through OPEX and VIX expiration. And we showed that there was a lot of short puts actually in tech stocks that funds had sold a lot of puts. Dealers were long those puts. That did get reset. So what does this mean? We're now back to sort of peak bearishness or peak options prices, peak puts in this space. And these names that have very elevated IVs, again, I think are interesting trades. No recommendations here, but we're going to look at something I think is interesting. And then you have like an AXP, Figma, Uber, anything basically that was adjacent to being, in the article or adjacent seemed to definitely, get beat up here. And those implied vols are pretty rich. Now, what is the difference between being able to trade vol as the trading vol versus price, right? You may say, hey, Brent, CRM is going to report the worst earnings in the world tomorrow. It's going down, right? And that may be true, but the implied volatility can also come down. Why? Because earnings came out, stock's already down. We'll look at, 30% a month plus. They're going to come out and say, we got to figure out what to do with AI. Everyone hates the stock, fine. But now we're out, right? The earnings are out. The news is out. There's no more surprises that are imminent. And so the expected move can come in, the volatility can come in, right? So you could have the options trade on, still make money, even if the stock goes down. So that's why the extreme IV is so important. Is like it's pricing in now 30%, let's say, continued downside in the next month. So if you don't get that, you get anything less than that, then that vol contracts and then you can make money on your trades, right? So we're going to check out that idea. But again, the takeaway from this is there's not that much put buying in this space, which is what you would think there would be put buying if you thought it was end of days for the software stock space. But options prices are now reflecting in some crazy premiums as they were last week, and everybody's super bearish on the sector. If there's one thing I believe is that when everyone's on one side of the train or one side of the bus or one side of the boat, whatever the saying is, boats falling over, trains crashing, et cetera. So you have to appreciate that one-sided view of things. Okay, so the underlying idea here is that we didn't see this bearishness on FinTwit, on Bloomberg, on Wall Street about this article translate into actual options trades. Period. Just didn't seem to happen. So let's do one other thing here. We have this report called Flow Patrol. Now, if you go to SpotGamma.com/Flow Patrol, you can download this report. You get it for free for 5 days. We email you a link to it. Why is this report important? Because we have proprietary data here at SpotGamma, and it shows you where funds are coming in. That's right, balancing all things. This report shows you where funds came in and bought and sold options. So you can buy a put, you can sell a put, you can buy or sell a call. Plus, not all volume is done by not all volume is done by just hedge funds or retail traders, right? You can have market maker trade the market maker, bank trade the market maker, et cetera. So when you see people on Twitter saying someone bought a bunch of these calls or someone bought a bunch of these puts, they're making a bunch of assumptions and they don't really have any idea necessarily what took place. Also, who were the actors? Because that's what matters. The inference is, or you imply that big hedge fund bought 10,000, CRM puts, and so it's going down. But what we're able to do here is glean and get more data and information saying, actually, here's what the funds did. Here's what a hedge fund did. This matters because they have a bunch of analysts on the desk, and if they think they're going to buy 50,000 CRM puts, well, they must know something, or they must have a much better view or understanding of what's going on. Because how do you parse all this right now, right? How do you know if CRM can defend itself or not, for example? So Flow Patrol breaks all this down for you, and it gives you the day-over-day change in what we view as buy-side positioning. Again, SpotGamma.com/Flow Patrol, and you can do this for free for 5 days. What I'm going to do here is I'm going to scroll through this, and I want you to, well, you can't stop me, but we'll stop when we see something related to digital payments, financials, or software stocks, anything like that, right? This is an AI written report. So what do we do here with AI SpotGamma? We'll use it to add something extra as opposed to take some stuff away, right? So I still manually write my report. Maybe people want me to actually, in fact, change my scheme here and use AI to write everything. But this is put together by AI, and it's a big help here, but it's always been an AI thing, right? So we're also very clear about that. We're never going to write something and pass it off as AI. Don't want to give you some slop. But what do you see here? Broad market. There's nothing in this open section here that talks about the Citrini macro headwinds, right? And it has access to that data if it wanted to note. What it did note was interesting. This BKLN, that's a senior debt ETF. I didn't know what that was, so that was kind of interesting. Silver real estate, no big deal, right? Biggest index positions on the day. We're going to roll through that. Biggest single stock positions. CoreWeave. Okay, you could maybe throw that in the Citrini bucket. PayPal, Tesla. So, all right, there's a PayPal trade. That was calls bought to open, BTO, 17,000. PayPal calls for 227 this Friday. Big swinger, right? As we talk about oftentimes with the report, the favorite trades that I like to see are somebody buying something 5-6 a year out, 5-6 months or a year out, putting a couple $1,000,000 down, and that is a position, right? I believe this is going to go up over the next 6 months. That is good information. Someone slinging for Friday, who cares, right? So you can see we break this down in a myriad of ways. I want to slow down to gamma. So highest, gamma is reaction to price, how the option price reacts to price, stock movement. And again, none of the top trades in here are any of those major names that we mentioned, Microsoft and Apple. So let's go to unusual positions. Let's try that. Unusual positions. Do we see anything in here related to the Citrini? There is this trade on Gauss. I'm not entirely even sure what Gauss is, so let's look that up. Gossamer Bio. That doesn't look like it has anything at all to do with, excuse me. Okay. Chewy, FND, Lucid, SLS, Abbott, Take-Two, maybe. But even this is a 1,700 lot of the stock. That's a 200 lot. So you're talking not even $1 million of premium. So where are all the apocalyptic positions? They're just not there. They're not there. One other thing. We were talking about the idea that a lot of options flows is let's just call it day trading. Right now, it can be day trading because it's retail guys. It can be day trading because it is an algo from a quantitative hedge fund, and they're buying single stock options and they're selling index options, or they're buying single stock options and they're hedging with whatever they may be doing, right? So what we do here is we break this down, because a lot of people say, hey, Brent, why didn't all the trades that took place in some stock yesterday show up on the Flow Patrol report? You're missing stuff. And my argument is that, to the point before, a lot of the stuff that trades isn't like a hedge fund or a retail guy buying or selling it. They're market makers trading with banks or whatever. And sometimes I also don't care if someone's day trading. If you're going to day trade the crap out of this stock, then I don't. That's not meaningful forward information, right? It was interesting for the day, but once the day is over, like, okay. So why does this matter? Look at a stock like this. Johnson & Johnson traded 462,000 options yesterday. Our open interest, our proprietary open interest, only changed by 11,000 contracts in total. Total open interest dropped by 800,000 contracts. So this gives us this flow ratio number. The higher the flow ratio number is, the more BS is in the stock. So when you scroll down this, you go Peloton, AI related name, I don't know, but it traded 50,000, only about a little less than 10% of that changed to actual material open interest. Intuit is a name, whispered along with this problem that has earnings coming up. So you look here and say, okay, 10% roughly, not even change in open interest. Here's OWL. You can make an argument that this is related to the software stuff. So, okay, about, again, 10% were not even quite changed in open interest. So it's a decent amount of open interest changing there, maybe. That's not a high premium stock, so it's not like that's a $10 million order. So again, everything you look at through all this options data is telling us that this software thing didn't move. Now, you want to make the argument that led to people just selling their shares. So like, hey, huge fund ABC just said, screw it, I'm out of this whole thing. Like, just dump my shares yesterday. Maybe, but they're definitely not expressing downside through put options for sure. And we're quite frankly not seeing much on the call side either. The only small light in terms of the call side was the ratio, like the call ratio being slightly above 1-to-1. Hard to really grasp at that. So, okay, so what have we covered here? Number one, options volume just doesn't care about the software stuff either. There's not any call buying in there, but there's also not any particular put activity that can change. So let's get to Los Alpha. This is IGV as a whole, and this thing, everybody knows this story already, but obviously this is just getting creamed. 34% from the high, 26% just over roughly the last month, and then the Citrini dropped at another 4 or 5%, I would say, kind of at least, and then something like an AXP, it too really got whacked pretty good. There's no follow through bounce on this, right? So if the article sparks something that was purely BS, then you would expect more of a bounce, but right now that's not necessarily falling through. So I want to talk about CRM and the trade idea that I see coming up here, because I think these types of trades are pretty interesting. Now, before we get into that, if you go to SpotGamma.com, actually we can just do this together. You can look at this through our free tools, or for SpotGamma, you have your dashboard. If you go to free tools and then you go to implied earnings chart, you get a pretty cool chart here. And the reason I like this earnings chart is you can open and close it, but we use the nearest options price, so Friday expiration for most of these things. And you see what the implied move is. So for CRM, the implied move is 8%. Again, they report on 2/25 today. A couple names here trading. Not sure if anyone necessarily cares about those. We also have Zoom, and then we have Into, CoreWeave reporting as well. So you can go through all these, but I'm going to talk about CRM. Even though NVIDIA reports tomorrow, I almost make the argument that CRM might be more interesting. So 8% implied move for CRM. So what does that mean? Let's take a look at this real quick and just see what 8% implied move looks like, because this will be interesting when we talk about levels later. So right now you have CRM stock in a month down 40%. It's crazy. Plus or minus 8% is roughly, call it 195 down to 160-ish, somewhere in that neighborhood, okay? So we got that down 195 to 160. Now, why does that matter? Because this is the cool thing, I think, to talk about here. So we're going to go into the volatility dashboard. I just want to talk to you about how we look at earnings trades, and we're going to look at CRM. So this is the 1 month skew for CRM. You can see the surface is a little sloppy. It's just not that smooth of a line in here. This teal range that you're seeing is the 90-day implied vol for 1 month options. So we're at the top of the overall range. Not terribly surprising in a name like CoreWeave. If we go back to the scanner just to break this down a little bit, I'm going to put this at put skew percentile and call skew percentile. And so CRM is right here. Why is that important? That put skew at 90% is about as high as it gets. What does that tell you? That the 25 delta put, so slightly out of the money put relative to at the money, very elevated, right? The call skew percentile, it's lower than 50, obviously, but it's not like it's 0. So calls are a little bit rich relative to at the money, and puts are quite rich relative to at the money. So that matters because overall IV is extremely high, but there's a little more put skew. So that makes sense, right? And let's just visualize what that means. That makes sense in saying this stuff down here is particularly rich, right? This stuff is rich because overall implied vol is high. In other words, this whole line is up on this chart, but the relationship of the two matters. Okay, so earnings are going to come out 9 times out of 10. What happens to implied vol after earnings? It contracts. Okay, fair enough. So we go to fixed. Let's go to term structure here. This is the at the money implied vol, extraordinarily elevated for this name, into earnings at 130%. And this is what we call backwardation because as we go out in time, that implied vol comes down. Names that crash, names that have earnings, are typically in this state. It means that near-term options have higher implied vol than longer-term options. Normally, after an earnings event, you would expect this vol to collapse. So we have this little tool in here called forward implied vol. Forward implied vol looks at 2 expirations, and it extrapolates what the implied vol is between those dates. And so what you can look here is you can see what the difference is. I look at forward implied vol and say, this is the target. This is where we think implied vol should go to right after earnings or after the event is over. And what you see there is for the 3/6 expiration, we would expect implied vols to go from 80 down to 45. And if we look out just a little bit further, we should see implied vols go from about 60 down to about 48. Okay. So that's interesting for CoreWeave. You can see that's about 20 vol points, let's call it, of decline. Okay. So why does that matter? We're going to take that 20 vol points of decline, and then we go to our new thing here. It's called options calculator. It's not new, actually. We launched a little while ago. I loaded up this straddle already. So let's display the P&L of the straddle. Now, if you use the current implied vols, I'm getting somewhere with this. Hopefully this is interesting for everybody. And we say, all right, roughly a week from now, 3/6, today's February 24th, so about a week from now, using current options implied vol, this is what you would expect to happen over 7 days. If the stock stays around this area, you can see current P&L would be about $400. So the straddle, just refresh these prices, make sure that's right. The straddle's going for about $24, $25. Maybe she's at 185 because stock changed. Stock's already dropped $5 since we last talked. All right, 185 straddle, that's better. And you can see here again, about $400, right? If the stock stays here after a week, because that implied vol is quite high. And I'm using 21 days to expiration, 1 month to expiration options. Okay. So what is the deal with the earnings collapse? Remember, I talked about 20 points of implied vol contraction. So if I go to IV settings here and we use current implied vol, and we just say, let's drop this down by about 20 vol points. So now IV goes to the middle of its current range, right? That might be a little steep, so let's just make it 14. Now, remember, put skew is a little bit elevated. We can take that down just a touch. And then let's just say bulls get excited again. We just raise that a touch. So what we're doing is we're shifting the skews here. And now what's going to happen is when we price this, we're going to see a different interpretation off of our implied vols of what could happen. Because remember, earnings should remove that implied vol. So how does that change things? Well, now if you look at the P&L, if the stock stays at the money, stays at 185 in the next week, that means you make $1,000 versus $440. So that's a huge difference. So when you adjust the skew and you adjust for the implied vol contraction, the P&L gets way better on this trade. But the other interesting thing here is that you go, well, Brent, what happens if the stock drops 10% or 20% or goes up 10 or 20%? You're short the straddle and the vol comes down, but the price moves so much that basically the price movement of the underlying stock washes out any move you made from vol contraction. Well, you can see now, because that vol contraction is so big, your break even in theory on the stock, instead of going from around 165, maybe a little bit higher, right, it drops all the way to 160, and then to the upside, you have all the way to about 205, right, where the P&L forecast to be negative. So that gets you an extra basically $5 on both sides of this equation, right, for that vol contraction, where if the stock stays inside of that range over the next couple of days, then you will likely make money in a type of position like this. Now, you shouldn't go into an earnings position unhedged, et cetera. This is for illustration purposes only. But the point here is the same. That implied vol is so elevated that even if it has a bad earnings announcement, the implied vol shows that if it contracts, you should still make money as long as the stock is all the way above 160. Now, how big is 160? Well, we were looking at this before. That's about a 10% move in the stock. Again, the implied move is about 8% for the near-term options. These are the longer-term options. So if you tighten up a little bit and go a little more forward in terms of the earnings, that band should expand a little bit. And so I looked at this trade, or I had a similar trade on for AppLovin, and the trade worked out pretty well because, yes, the stock dropped pretty sharply after earnings, but again, you make a decent amount. So right here is the earnings drop, and a similar trade worked because, yes, the stock drops 20%, which is huge. And I happen to be in December, which is a little bit too far out in my taste, but the longer you go, the more padding you're going to get, arguably. And so that trade ended up working out okay, and was profitable because the stock, because the vol contraction proved to be profitable enough to pad me on that underlying move. So so these are very interesting trades, I think, for CRM. Maybe zoom into, again, anything that you see at the top of this scanner's page is a great spot to start and say, okay, these names up here are implied vols just so over the top rich that we may be able to put on similar types of trades. So hopefully that's interesting and helpful, and gives a good narrative, a good breakdown for what's happening. And again, if you are interested in this is free tool, you can go there, SpotGamma.com. Free tools, implied earnings tools, you can hit there, and this is there in perpetuity. It's been there for forever, and you can get all the latest earnings earnings implied moves, talking too fast there. And then if we go to SpotGamma.com/Flow Patrol, you can sign up here for Flow Patrol. You get this 5 days free, put your email in, bam, you get it to your inbox every day. And then you can break down how those options flows are helping. All right, I've yapped for a solid 30 minutes now. Hope this was helpful. If you found it interesting, let me know. If you didn't find it interesting, let me know, and I'll try to get better in the future. But that is it for me. If you're a SpotGamma subscriber, I'll see you for, I think, Thursday. We have our Q&A. Also have a lot of cool tools coming up. Big update on trades coming in hopefully about a month. We're getting all that all queued up. And that'll do it for me. Any questions, info@SpotGamma.com, or leave comments, and